We're seeing worries across multiple dimensions of the economy. Relative to 6 months ago, we have consumers not only worried about business conditions, they're also worried about their personal finances. They're worried that unemployment's going to go up. In fact, they're worried that their own income growth is going to slow down. And they're worried about stock market performance. They're worried about so many different things about the economy, and the signs are all moving in the same direction.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. For a while now, the soft data, like confidence surveys, have indicated worry that times are getting tough. But the hard data, like the unemployment rate, corporate profits, retail spending, etc., have shown that the economy is proving quite resilient. So, why the discrepancy? And which data set should we be giving more weight to? For perspective, we're fortunate to welcome back to the program Joanne Hsu, Director of the Surveys of Consumers at the University of Michigan. If you've ever heard of the University of Michigan's highly influential Indices of Consumer Sentiment, Consumer Expectations, or Current Economic Conditions, well, Joanne's in charge of those. Joanne, thanks so much for joining us today.
My pleasure to be here.
All right. Well, look, thank you so much for coming back on the program, Joanne. We just had a chance to chat last year. A lot has happened since then. And you have probably better than most anybody in this country, have your finger on the pulse of the American consumer more closely than, like I said, probably anybody. So very curious to hear what you're learning from the surveys today. We talked off camera about how we just connected that we both went to the same undergraduate program. So it's fun to have you back on now, knowing that you are a fellow alum there. But look, let's just get to the meat of it right away if we can, Joanne. What are the University of Michigan surveys currently telling us about consumer sentiment?
Over the course of 2025, consumer sentiment has been went on a 4-month consecutive slide, 4 consecutive months of very strong declines in sentiment. And that's been very much attributable to concerns over volatile trade policy. And interestingly, in the middle of May, after the reversal of some of the very high, or the pause on the very high tariffs on goods from China, consumer sentiment has ended that slide. So by the end of May, the bleeding appears to have stopped, but overall, we have very low consumer sentiment. Consumers are broadly anticipating a slowdown in the year ahead.
Okay, slowdown. Let's dig into that word. Are they expecting the economy just to become a little bit more sluggish, or are these really fears of like a recession?
We're seeing worries across multiple dimensions of the economy. Relative to 6 months ago, we have consumers not only worried about business conditions, they're also worried about their personal finances. They're worried that unemployment's going to go up. In fact, they're worried that their own income growth is going to slow down. And they're worried about stock market performance. They're worried about so many different things about the economy, and the signs are all moving in the same direction.
So, okay, so I mentioned in the intro the difference between the soft data and the hard data. And if you hear U.S. Treasury Secretary Scott Bessent being interviewed on the media, it's like every week they basically kind of hammer him over the head with both consumer and in general CEO sentiment data. And his response to date has been, I've been around the block a fair amount. The soft data doesn't always materialize into the hard data. And right now, the hard data is looking pretty good. And I'm not going to worry too much about the soft data unless I see it reflected in the hard data. Why do you think we're not seeing the hard data be more effective at this point if sentiment is kind of as dire as you seem to be saying it is?
It's very important to consider the time periods that are covered by these different data sets. When people refer to hard data, they're often talking about GDP growth or unemployment rates. And those are data points that are backward looking. The latest data for a lot of these things is April, hasn't covered May yet. And in contrast, consumer sentiment, CEO sentiment, these are very much forward-looking. This is what consumers and CEOs are anticipating for the future. So given that the past and the future aren't necessarily the same for a lot of the time, it should be no surprise that these indicators don't always look the same right now. What I would point out is that part of the strength in consumer spending that we had been seeing over the last few months is not actually coming from a position of strength. When we dig into our data after the election, we saw a surge of consumers saying now is a good time to buy big ticket items. And usually that's a sign of strength. But when you look at our open-ended questions, it becomes clear that the majority of consumers who've believed this were telling us that now is a good time to buy in order to avoid price increases in the future. So this wasn't coming from a position of strength at all. This was actually coming from anticipated weakness. And indeed, we saw very strong sales in Q4 of 2024 for durable goods as well as automobiles. And we saw some strong retail spending in Q1 of this year as well. But given that consumers feel so bad about their own incomes, and that had been the thing that had supported consumer spending despite low sentiment numbers over the last couple of years, that support isn't there anymore. And that spending that's based on weakness right now is not sustainable.
Okay, so sort of like corporate America, which did a whole bunch of inventory front running of the tariff impositions, it sounds like the consumers sort of followed that lead and said, hey, look, if these items are going to go up in the future, I may as well get them now. True?
That seems to be what we're seeing. And I think that's particularly the case among higher income consumers. The sharpest drop that we saw since the beginning of 2025 has been among highest income consumers. And this is particularly concerning because high income consumers generate the vast majority of aggregate spending. And they have the ability to front load their spending, pull it forward. And that's indeed what it looks like that they did.
Okay, and I was actually going to get to this in a bit because I think we addressed the wealth divide last time you were on. But a lot of what appears to have been propping up things like retail sales has largely been the affluent consumer who definitely kind of punches above their weight in terms of their spending. You're saying you're now beginning to see, panic is too strong of a word, but anxiety and worry amongst that wealthy cohort too.
We're seeing a very strong deterioration in the outlook for the economy for that group, for that higher income group. And this is very different than what we were seeing in the post-pandemic inflationary episode. During that time, sentiment very famously hit an all-time historic low in June of 2022. And right after that, as inflation started to slow, for lower income people, middle income people, sentiment didn't really improve a whole lot, but for higher income people, sentiment improved quite dramatically. And that's something I think we talked about last time. Yeah. And that was very much what supported the robust consumer spending during that period after the pandemic. The people who generally generate most of spending, they were feeling pretty confident relative to the year before, and that showed up in their spending. Now we're in a completely different situation. Labor markets are nowhere as tight as they were 3 years ago. And we now have about 2/3 of consumers expecting unemployment to go up. Normally, it may not necessarily be a problem if a lot of people think unemployment is going to go up, if they believe it's something that will happen to other people and won't affect them. But what's different about now relative to the last few years is that we have a surge in the share of consumers who are worried about losing their jobs in the year ahead. And when we ask them about their income expectations for the future, that has been weakening across the board, including among higher income folks. And so that's really concerning. If you do not feel confident that your incomes are going to remain strong, that you're even going to keep your job or continue to have a stable level of income in your house, you're not going to feel secure enough to keep spending amid low confidence for the economy. And this is a very different situation than we were in right after the pandemic.
All right. Well, as Gandhi famously said, our beliefs drive our actions, not the other way around. So if we believe that tomorrow is going to be tougher, we're going to start taking actions to start retrenching in advance of that. Let me ask you this. So you talked about how the hard data tends to be more lagging, right? Where sentiment tends to be more leading, right? Because the sentiment's the belief, and then the hard data is the action. Historically, what's been the correlation between where sentiment goes, where the soft data goes versus then where the hard data goes? Is it close to one? Is it only like a half? They're not even correlated? how much confidence do you have that the hard data is going to follow the leading sentiment data based upon the historical correlation?
Historically speaking, research has shown that consumer sentiment has additional forecasting power above and beyond the typical backward-looking indicators that usually go into a forecasting equation. So it's not that I believe that sentiment alone predicts things, but it has additional predictive value above and beyond the other traditional indicators. And typically speaking, when we look back to the data that we've been collecting since the 1950s, when sentiment is tanking, it tends to precede a recession. A recession tends to hit soon afterward. And when sentiment is on the rise, the economy tends to grow. So that's an economic regularity that we've been seeing for decades and decades. Now, this relationship did change right after the pandemic. And of course, during this period right after around the pandemic, a lot of different economic relationships changed, right? Like the inverted yield curve was no longer predicting a recession.
Right.
And you know, the Somme rule triggered and we weren't in a recession. So a lot of different things went into flux because of the recession. And that's why I like to make comparisons to our current situation to what we were seeing right after the pandemic. We're at similar levels of sentiment as we were in June of 2022. We're just within a few points of that period. And you know, that had a steep decline. We have a steep decline now. But what's very different is the labor market, not just in terms of the current state of the labor market, which is currently strong, but nowhere as strong as it was in 2022, but in particular, the labor market expectations. Consumers are worried about weakening incomes going forward. And strong incomes was the thing that allowed people to keep spending even when they didn't feel good about it. And that support just isn't there this time around.
Got it. Yeah, they don't have the bargaining power at work that they did. Let me ask you this, Joanne. I mean, I know you focus primarily on consumer sentiment. Do you know what the CEO and executive surveys are telling us about their expectations for what they plan to do with their labor? You know, are they planning on layoffs going forward from here? Is that spiking?
I'm not super familiar with the details of CEO plans, but what I know is that the conference board puts out a CEO sentiment survey or CEO confidence index, and that showed really strong declines over the last few months. It very much mirrors what we were seeing on the consumer side. And this is no surprise. You know, when we look at the open-ended comments on that consumers are leaving on our interviews, we see a lot of them noting that in a volatile policy environment, particularly around trade policy, it is very difficult for businesses to plan. And consumers recognize how difficult it is for businesses to plan. And that's part of the reason why consumers are just really bracing for impact from anticipated price increases. They are expecting higher tariffs and also tariff uncertainty to pass through to consumers in the form of higher prices. So, you know, in this moment, I think consumers are quite aware of the challenges that businesses face, and they are concerned that those challenges will pass through to them as well.
All right, and I must admit I'm not shocked, but I'm a little bit surprised that consumers are as in tune to what it seems like corporate executives are feeling and thinking right now, everything from the front running to the worries about the layoffs. I mean, obviously you work for a company, you can pick up the vibe on what's going on there, but I've always sort of thought that consumers will just do whatever they're going to do up until the point that they're actually forced to change their behavior. But it seems like they're seeing enough warning signs that they're actually starting to really you know, at least change their beliefs about what's happening based upon kind of what they're hearing and the vibe they're getting in the workforce. Let me ask you this. So do you kind of see then the economy as sort of in this Wile E Coyote moment where sentiment has gone very negative, it's shifted, consumers, I guess, must be changing their purchasing behavior. Now, maybe they changed it recently to pull some demand forward because they were afraid of the tariffs. But now, A, they've done that. So, you know, some future demand was pulled into yesterday. And secondly, if they're worried about getting laid off, they're probably going to start tightening their belts just to, you know, have some cushion there in case they do get laid off in the future. So are you sort of expecting us to start to see the hard data really start to head downwards soon based upon where sentiment is right now?
I mean, the April numbers for retail sales were not strong. So I think we're already seeing it in the backwards looking economic indicators. And indeed, when we ask consumers, are you planning to cut back on spending on things with high price increases going forward? We have a large share of consumers saying, yes, I'm planning to cut back. I'm not going to hold my consumer spending steady. And this is in contrast to when we asked these same questions 3 years ago, 3 years ago after the pandemic. Back then, there were many people who said they were going to cut back, but there was a large share of consumers who said, I'm not planning on making any changes.
Right.
So
Because they
consumers
were
do
either getting checks or they had, moratoria on a lot of their expenses, which obviously they don't have now.
That's right. That's right. I mean, I think there were a lot of things that were supporting folks' income back then, in particular, strong labor markets, strong asset values, and at the bottom of the income distribution, stimulus checks and other supports from the federal government. And those things aren't there anymore. Across the board, the strength and incomes that people were experiencing in 2022, 2023, they're not in play.
All right. Okay, so it's going to be very interesting to see what happens, but obviously don't want to put words in your mouth, but it sounds like you would not be surprised to see the economic data start to build momentum to the downside here. I know you're not a market analyst, but I'm going to guess, and correct me if I'm wrong, wouldn't be super surprising to you if the stock market, ended up going through some sort of correction later this year because of lower corporate profits, because of reduced consumer spending. I'll take a beat here, but is what I'm saying make sense to you, or do you have a different opinion?
All of this makes sense to me.
To my question, sounds like it wouldn't shock you if that were to happen.
No, that would not shock me.
Okay. All right. So let me ask you this, Joanne. There was a fair amount of media coverage a few months ago. I think it was mostly around like inflation expectations. But you were seeing consumer sentiment really diverge based upon people's political party affiliations. So two things. One, what was that true? And just what can you tell us about some of the, maybe the relatively new dichotomies in the data sets with the new administration? And then secondly, to people who might say, hey, this negativity, it's skewed to the downside because of all the people that didn't like Trump, and they're just, they're feeling like the world is ending. And so their dire feelings are kind of dragging the averages of the surveys down. But if it weren't for that sort of political belief, maybe things wouldn't look so bad.
I'll address those questions one by one. So
Yeah.
first of all, partisan differences in sentiment and inflation expectations, they're not new at all. We've been seeing them since at least the Reagan administration. It is always the case that folks whose political identification or political affiliation are aligned with the White House, they tend to have more favorable views of the economy than if your party is not in the White House, and independents are right in the middle. So again, we've been seeing that since the Reagan administration. It is true that the partisan differences have grown over time, and they grew in particular between the Obama and the first Trump administration. That partisan gap between Democrats and Republicans really grew, I mean, almost doubled between those two administrations. It shrank a little bit under Biden, but has grown again under the second Trump administration. So what we are seeing with Democrats and Republicans, they kind of switch deck chairs. They rotate around independents when the White House changes hands, and that's something we've seen many times. We've been seeing that for decades. So this is nothing new. But it is, like I said, the partisan gap is a little bit bigger now than it had been under the Biden administration. And then on your second point, I think it's a really important thing to understand how are we seeing this 4-month slide, and to take a look at that. We've been publishing results separately for Republicans, Democrats, and Republicans. Did I say that right? We've been publishing for all three political groups, Democrats, Republicans, and independents. And the really interesting thing is, even among independents and Republicans alone, we've seen a strong deterioration in views of the economy. So we see the three groups essentially moving in parallel from January through May. And so now, it is true that for a lot of Republicans, they're fully in agreement and alignment with White House policy. But overall, in April and May relative to January, they think the outlook for the economy has deteriorated. We have 2/3 of consumers spontaneously offering comments about tariffs. We're not asking them specifically about tariffs. These comments are just coming up unsolicited, and that includes a majority of Republicans. And people who mention tariffs tend to have much more dour views of the economy than people who don't mention tariffs. Even among Republicans who are broadly in agreement that tariffs may be a good thing to bring manufacturing back or serve another long-term goal, but they all agree, Republicans and Democrats and independents all agree that the short-term outlook for the economy has definitely soured over the course of 2025.
Okay, good. Yeah, and that's the clarity that I wanted to get, which is the deterioration in sentiment that you're seeing. It's not really partisan driven. Yeah, maybe
No,
it's
it's
a
not.
bit stronger in some partisan groups than others, but it's a universal amongst all the groups. Yeah, and to your point, I mean, even the people that might think, hey, this is the medicine we need to take, it is disruptive. It makes you nervous. There's obviously risk involved, and so folks are getting greater anxiety. And I imagine that what you probably take from that, as a researcher, is if the Republicans, want to have good results in the midterm election, they better put some wins on the board between now and then economically to show that the disruption that's going on right now, is going to be yielding some fruits. Because I imagine if not, and we just sort of stay in this valley of anxiety, if the elections get close, that probably doesn't bode pretty well for the incumbents.
Overall, across political party, the instability of trade policy is something that's really captured the attention of American consumers. And this isn't the case for other policies coming from the White House. Like I said, 2/3 of consumers mentioning tariffs, and invariably they have worse views than people who don't mention tariffs. Meanwhile, if you look at comments about immigration or comments about DOGE, those are very mixed. Some people think it's a good idea. Some people think those policies are a bad idea. So there is something very specific about tariffs. And when you drill down a little bit more into these tariff mentions, it's not just the idea that tariffs might be high or might stay high or become high. A large share of these consumers are mentioning unpredictability, instability, uncertainty. So it's the uncertainty, the volatility of policy, policies changing every hour, every day. No one has any idea where things are going to land in the next few months. That's something that's causing quite a bit of anxiety among consumers of all political stripes.
Joanne, is the worry more this uncertainty and tariffs are going to, restoke inflation, and I'm going to be paying more for stuff, and I'm still smarting from all the inflation that happened over the past couple of years? Or is it more, I'm less worried about being able to pay for stuff because the price has gone up. I'm more worried about paying for stuff because I might lose my job.
It's both. And that's really the troubling thing. If it were just the former, it would be easier for consumers to maintain the high level of spending that would prop up GDP. But it's not only that they continue to be very, very frustrated by the persistence of high prices. Now, on top of the pain of high prices, they're really worried that their incomes are not going to keep pace. They're worried they might lose their job. The share of consumers expecting to experience a layoff over the next 5 years, that is up substantially over the last 6 months. And with this level of consumer worry about their own incomes, about their own personal finances, it's hard to see why consumers would be willing to go out on a limb and spend a lot of money.
Okay. I'm just going to do a quick plug here, Joanne. Folks, if you have yet to read the free layoff guide that Thoughtful Money has published, I do highly recommend it for anybody that works for a paycheck for a living. If you're dependent upon your employer, that means, in some way, shape, or form, you may be vulnerable to getting laid off. The layoff guide walks you through a whole bunch of things you can do now in advance of a layoff to hopefully reduce your vulnerability to one, either reduce your vulnerability to getting laid off, or if it happens, making sure that you're as cushioned from that as possible. And if you do get laid off, there's a lot of things in the guide that you should do right when you get laid off that are really important to know about. So again, to go get that free guide, if you haven't yet already, just go to thoughtfulmoney.com/layoffs. All right, Joanne. Well, look, you collect a lot of information and feedback in your surveys. I'm curious, do your surveys reveal any reforms or desired shifts in policy that consumers would like to see?
The number one thing is they do not like inflation. They do not want inflation to come back. They recognize inflation is slower than it was in 2022, but high prices continue to dent their wallets, and they continue to be very frustrated about that. So that, I would say, is policy wish list number one: get inflation lower and get the cost of living lower. Tariffs are a big part of that. I think it's very loud and clear from our interviews that consumers are really worried about the volatility and unpredictability of trade policy. So if trade policy were to stabilize, I think that consumer views would improve quite a bit. As I mentioned before, they're worried not only that tariffs are going to lead to higher prices for consumers, but they are also worried it's going to make it much more difficult for businesses, and that those businesses are not only going to raise prices, but also that those employers might lay off their workers. So consumers are worried about being hit on both ends. And anything the government can do or policymakers can do to alleviate that worry, I think would be more than welcome.
Okay. I'm just going to ask you to just postulate with me here for a moment. So I mentioned the midterm elections, and I don't have any inside channel of the current administration, but I can guess how they might be thinking, right? Which is, okay, we got to show enough positive momentum far enough in advance of the midterms to try to have a shot at retaining control of Congress. To the point you just mentioned, where consumers would like to see more clarity, what do you think is kind of the minimum that the minimum bar that the administration would need to show? Like just announcing trade deals and saying, hey, the daily news bombs of tariffs on, tariffs off is now over because we've come to new trade deals with folks, even if it might take a couple, year or more, 2 years, 3 years for those trade deals to really get fully enacted. Would it be pointing to, agreements of foreign companies to build factories here and begin to reshore jobs here? Or are people going to need to see more than that? Not just words, but actually like, oh, the unemployment rate is going down again, or prices are now coming down. They're not just, inflation's not just stopped; they're coming down in some of the things I care about. Like, what is that minimum bar where you think, okay, the administration can maybe hold on to Congress if it does at least X, Y, Z?
So I think that consumers are just really anxious about the fact that there are differing, changing news about trade policy on an almost daily basis. I think there was quite a bit of optimism that temporarily came in on April 9th when the reciprocal tariffs were paused. But that pause didn't really stem the flow of trade news, right? Like there
Right.
were
I mean,
continuous.
besides the UK deal, there really hasn't been anything that's been resolved, right?
Nothing's been firmed up. And I mean, I think that it doesn't necessarily require a bunch of bilateral trade deals announced. I think an announcement that we are holding tariffs steady while we negotiate everything for the next X months or the next year. I think that could be enough to help many consumers feel like there's a little bit more certainty. It's the fact that policies are being announced constantly, things are being paused, not rolled back, but paused, and that pause can be unpaused, or new tariffs can be announced at any time. There is some part of the consumer population that views this as a negotiating ploy or a negotiating strategy. And whether or not that's the case, it's still giving consumers overall whiplash. They recognize that businesses can't plan, and they feel like they can't plan either.
Okay. And again, I'm just asking you to totally postulate again here. Is there a time frame where you think, hey, if the administration's going to do that and win over the populace with it, that they need to do it by? In other words, while they won't like it, can consumers withstand this uncertainty until the new year? And as long as this, clarity, or at least end of the chaotic news bombs, ends in early 2026, maybe we'll be okay? Or is this something that, like, if it lasts beyond August, it's just doing too much damage to the psyche?
What we know is that inflation hasn't picked up yet. But this is in accordance with what a lot of economists believed, that any price hikes and increases in inflation would take several months to pass through to actual prices after the tariff hikes began. And so if it is the case that foreign suppliers or domestic producers, importers eat all the price hikes, eat all the tariff hikes, and the prices are not passed on to consumers, things might be okay, but there isn't really any indication that that will be the case, that these tariff hikes won't be passed on to consumers. I would say that the time to stabilize policy for the consumers' benefit was yesterday, and then the next best is today. So, consumers are waiting for the other shoe to drop. For consumers to believe that policy has stabilized, that takes time too, right? Like, you can announce a policy shift now that says, I'm going to keep policy stable, but consumers have been burned many times with what looked like a stabilizing of policy, which eventually just turned into more and more policy changes. So it's going to take some time of stabilized policy before consumers are confident that that's going to stick.
Okay. And obviously, too, if inflation doesn't materialize because the economy has tipped into recession and there's no upward pressure on prices because consumers just aren't spending, that's not going to be a good thing either. So, all right, well, I guess we'll all cross our fingers and just hope, clarity comes as quickly as it can. Joanne, look, I really value the work that you and your team do at University of Michigan. Kind of used an analogy here. The hard data is more like the trailer that's being towed behind the car. Your team is much more like the headlights, right? That are showing us what the road ahead is going to look like. Yeah. So is there anything else material in the insights that your team is collecting right now that I just haven't thought to ask you about that's worth talking about here?
It's something that I touched on toward the beginning of our interview, which is that the deterioration in views is not limited to one group. It's across the board. It's across demographic group. It's across political party. And most concerningly to me, it's across multiple dimensions of the economy.
Right.
So this is one of those situations where the message is very clear from the consumers. They're really worried about the future, and they're worried not just about inflation, but they're worried about themselves as well.
Okay. Well, look, the message I take from that is confidence is high that both consumers and corporate America thinks tougher times are likely to lie ahead, and we would ignore all that at our peril. Joanne, for folks that have really enjoyed this conversation, would like to follow you and your work in between now and the next time you appear on this channel, where should they go?
They can go to our website at www.sca.isr.umich.edu.
Okay. I'm going to try to cram that on the screen here when I edit this, but if I can't, whether I can or I can't, I'll also put it in the description below this video. So folks, if you want to get there with one click, you can just click that link. Joanne, always a pleasure. Thanks so much for coming on.
It's a pleasure to be here.
All right. Well, now's the time on the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual this week by John Lodra. His partner in crime, Mike Preston, is away today. Hey, John, how you doing?
Hello, Adam. Great to be with you today. Thanks for having me. And I really enjoyed listening to your chat with Joanne. Part of what that reminded me of, and something that we remind ourselves every day, myself and my partner, Mike Preston, we've been doing this, managing hands-on investment portfolios for everyday real people, real clients, for each of us about a quarter century. So we've seen it all, and we've learned a lot and continue to learn every day. Because what we have found, and this gets to the notion of sentiment, is markets aren't just things that follow financial theory. They are the intersection of finance and logical stuff, but a whole lot of illogical or complicated feelings and psychology. And that's why you hear these cliches. For example, markets climb a wall of worry and things like that. And frankly, we spend probably as much time with our clients in aggregate talking about nuts and bolts investment things or psychological things or feelings as much as we do nuts and bolts financial things. And sentiment's a really important thing to be aware of, try to understand, but also understand the trip ups. That the whole cliche "markets climb a wall of worry" speaks to the fact that sometimes the feelings and sentiment project a situation that is actually a prescription for doing the opposite. And it's not quite that simple, because right here and now, there is definitely really credible data derived reasons to be cautious, not full on rampant speculative, but cautious, but not as cautious as we think some of the sentiment numbers of recent times would suggest would be the right thing to do. So I'd love to dive deeper into that. Maybe elaborate a little bit more of how we use sentiment and how we don't use sentiment in our process, hopefully to educate your viewers. And of course, here we are today, Adam, recording this on Thursday, June 4th, and we're right smack in the middle of some reports on the jobs picture. Yesterday, we had a soft data point in what's called the JOLTS survey. It's a survey of companies and their job opening stats and how many open jobs they have. And it actually surprised, you might say, to the positive. In other words, companies had more openings than one might have concluded they would, more hiring plans than one might have concluded they would, if you believe the sentiment of CEOs and the pessimism that we saw in the height of the tariff news coming out last week. Today we saw a hard data survey. The ADP job report came in softer than expected. It's a very notoriously noisy month-to-month reading. Tomorrow we have another survey-based, soft-based read on the job market in the BLS data. We'll see what that holds. But the jobs market, I'd say in a tidy summation, these both hard and soft data points are a mixed picture. There's not a very clear picture at this point in time from our take. But I'll pause there, and then we can kind of go in any direction you like, Adam.
Thanks. Right. I'm glad you mentioned both of those reports, because yeah, I saw the JOLTS come out and like, oh, that contradicts a little bit of the sentiment that Joanne talked about, and then of course the ADP one, which was a pretty big miss. I think the number came in about a third as much as what expectations were. I think it was like a 5 sigma miss. That obviously adds some validation to her point. So as you said, a lot of noise out there right now. We'll get the BLS numbers soon. We'll sort of see what's going on here, but. What I took away from Joanne was she's been doing this for a good while, and that she has not seen sentiment this low and erode like this kind of across the board, both in terms of consumer households, but also corporate executives, both on the lower and middle classes, as well as that affluent consumer. So, what I kind of took from her was this sense of like, wow, this is kind of pervasive in a way that's quite rare. And she didn't seem to feel like we were at a turning point anytime soon. She wasn't seeing, necessarily a light at the end of the tunnel yet. Now, obviously, this is all soft data, and I talked with Joanne about the differences between soft and hard data and whatnot. But I do think it's worth paying close attention to when somebody who is a student of sentiment says, "Wow, these are pretty strongly negative readings."
Yeah, Adam, and I thought you asked a great question of Joanne insofar as you asked her, look, what has been the historical usefulness of these soft surveys in predicting the follow through or not of the hard data? And I thought she gave a very nice balanced response to that, in that she framed this as, this soft sentiment data has been shown to improve the forecasting accuracy of the economic trends and maybe even market trends. I know you and she didn't specifically talk about the market conclusions. We can certainly, I can certainly offer our take on that from here in New Harbor. But I think she probably framed it as a useful element in improving the ability to forecast or anticipate trends versus just looking at hard data alone. But I was glad that she didn't say, this is the panacea of having a perfect, leading indicator as to what the hard data will be. And I think that's really important because it represents, a piece of the equation, a piece of the puzzle, very much in line with our approach that, takes this kind of concept of a weight of the evidence approach. Rather than light switch on-off indicators, we look at a broad range of data that in concert creates a weight of the evidence view or picture of what likely emerging trends, either positive or negative, are to be. And the problem that we have found with sentiment, and we know it in ourselves as humans, and we see it in everyday people we work with, is we tend to latch on to certain things as if it's the only thing that matters. So obviously, everybody with a pulse, whether you're talking about steady at the hand, at the helm CEOs, or people at home that don't really understand financial markets, but have seen all the news about tariffs. Rightfully, everybody has been very concerned about that, as if for no other reason of the uncertain picture that it lays out. But there was a whole lot to look beyond just the tariff news, right? We had a very sharp sell-off in April. We were glad to have been, very hedged for that, and the downside was quite muted for our clients. But just as importantly, we saw, and this maybe dovetailing back into sentiment, as much as kind of behavioral or consumer or kind of qualitative sentiment factors are useful to get a piece of that picture. We generally put much more weight in kind of market investor sentiment, and even more so price action and action in the market, because there's another cliche, another saying that sentiment follows price. And the notion there is, well, yeah, as prices decline, people tend to get negative, and as prices go higher, perhaps oftentimes in opposition to their expectations, they finally jump on, and their sentiment becomes better, maybe out of submission rather than conviction. But if we go back and look at, for example, some soft data readings on investor sentiment, I know you and we and many of your guests, noted, for example, in April, a very popular sentiment indicator on individual investors, the AAII bull bear survey. It basically is a way of measuring the survey-based sentiment of that pool of investors. Was record bearishness, the kinds of levels that you would see only at like major market bottoms, like the bottom of the tech bubble or the housing bubble. So those were very negative. But if you look at the actual hard data of investor behavior, particularly in the so-called retail investor, they were very heavily invested. In fact, in some ways, they were levered long, record purchasing of levered long ETFs. So sometimes in the data, you can see, contradictions between people's feelings and what they say and what they actually do. And that's why we generally prefer to put much more weight on market-related sentiment or price readings than we do these qualitative things. I'd like to share one chart before I hand it back to you, Adam, because I can go on and on here. But let me share a chart here that is just one glimpse of a market-based sentiment indicator that we look at. Just one of many. But let me share this screen. This is a indicator, what's known as what's called a bullish percent. Okay, and what a bullish percent is, it measures the percentage of stocks in a given universe that are on buy signals. And what I have here, I've compared 2 points in history, and I'm going to compare where we were at the bottom, like the market bottom in the COVID sell-off in March of 2020, versus where we were yesterday. Okay, just as an example. And each one of these squares here is a sector of the stock market. And what you see here are ranges here from 0 to 100. Basically, when things are to the left here, it means that a very small percentage of stocks in these respective sectors are on buy signals, okay? Meaning that, basically the sellers have capitulated. They've sold, they've thrown in the towel, and you might call this washed out. And to my earlier point I think I made, we tend to use sentiment mostly as a contrarian indicator. We find it most powerful when it gets really extreme to one degree or another, and especially on the downside. There's a saying that market bottoms are an event, market tops are a process. We tend to find that very low readings on the downside are more reliably predictive of at least a short-term bounce than extremes on the high side. But this is going back to the bottom of the market in the COVID bubble. And you can see we got really washed out here, where almost every sector had a very few percentage of stocks in those sectors that were on buy signals. Let's look where we are as of yesterday. This is what the picture looks like yesterday. Not extreme. Oftentimes in very toppy markets, we'll see it much more extreme to the right here. And there is something to be pulled out of here at the sector level. For example, if I pulled up a chart here showing the late '07 market, you would see that the skew is much farther to the right, meaning there was exuberance, but the banking sector was hanging out kind of by itself down here, meaning that the banking sector was already starting to sell off even before the mainstream market got a whiff of, hey, we got this thing called subprime that's a big problem. But this is just one of the kind of like market action indicators that we prefer as a measure more so than these qualitative sentiment things. So I'll hand it
Okay.
back to you, Adam.
Well, that's super interesting, and it's a good segue to the question that I want to ask you here, which is, um, first, when it comes to your job as a financial advisor, right? First, you sort of have to determine, okay, how do I want to construct the portfolio and what makes the most sense for my client's goals and all that stuff, right? Then you have to try to figure out, from a valuation standpoint, um, are today's valuations attractive or not, right? And it's worth noting on the day we're talking here, the S&P is getting close to 6,000. So we're getting back close to the market high, from which it then had a notable correction in March and April. So there probably are some worries here that, hey, things are getting pretty richly valued. Not everything based upon the distribution you showed us, but that's the momentum where things are going. But then you have to start taking into account things like sentiment, right? So, Joanne's data, like, oh, all right, well, look, a lot of people are more worried about the future. And if that's going to make them change their behavior, whether they're a corporate executive or whether they're a consumer, that might have knock-on effects for spending, and then that might have knock-on effects for profit margins and yada, yada, yada. And then, we have this crazy, chaotic, macro-driven news bomb market where, like, every day there seems to be a pretty material head spinner of an announcement, whether it's tariffs on, tariffs off, or hey, it looks like the Russian-Ukraine is going to reach a peace settlement, and oh no, they're bombing each other with drones again. That's off the table. We just had it kind of going on in real time right now, what appears to be somewhat of a rift or a defection between Musk and the Trump administration. Musk was totally on Team Trump, and Doge was a huge part of what was going on there. But all of a sudden, Musk is really playing hardball about the big beautiful bill, thinks it's an abomination. Sending a lot of slings and arrows for any Republicans that vote for it. So there just seems to be a hyper uncertainty right now on the macro side of things. So I'm sure there are other spinning plates there that you have to consider as a financial advisor, but how do you kind of manage all this together? Seems very hard and chaotic.
Yeah, it is a challenging multi-factor type of problem, right? And there's no perfect answer, right? And this is, of course, when you factor in psychology, even more so. There's a good answer, a right answer, whatever you want to call it, for every person. Our job is, we think, to meet our clients where they are, try to be that. I think one of the best things that each of us can do to check our own biases and overly exuberant or pessimistic sentiment is to challenge ourselves with other people's perspectives. Talk to a friend, talk to a family member, read commentators that, maybe the headlines on the surface don't agree with your biases. I guarantee you we can all learn something by doing that. We happen to think our role as financial advisors is one of those very important ways to help our clients check their own biases. So we spend a lot of our time really validating, understanding our clients' concerns. Not, and I don't want to say disagree with them, because our job is to, we think, be an independent ballast point for them. So we can oftentimes walk them through their concerns and enlighten them to the degree we can be as certain as we can, which is there's always degrees of uncertainty in what we do. That's the reality. We think in terms of probabilities,
Right.
but our job is to help them, I think, look at the likely range of scenarios, which oftentimes is maybe at odds with how they're feeling. Sometimes they're feeling more exuberant than they should, but you look at where we are. Categorically, valuations are extreme in the US anyways. whether you look at it on like a forward PE basis, we're at 22 or 23, you know, give or take, very extreme. We've rarely seen valuations that high. If you look at more big picture valuation metrics that tend to have a more robust predictive value for like longer term returns over say like the next decade, things like the CAPE ratio or even like Warren Buffett's, market cap to GDP. Those are extremes, and some of the most reliable indicators, we've only seen extremes like this at the tech bubble peak in 1929. Now there's a fair amount of empirical debate over this in terms of, hey, our valuations, based upon today's index composite, which is largely weighted towards tech companies that have strong recurring cash flow, very strong return on investment. Should they be anchored at the same average valuations, that index, as say an industrial heavy index in the 1970s, for example? All very valid things to challenge. We think that it's somewhere in between. We don't think that argument invalidates the extremity of the valuations. But there's some moderating factors there in that debate. So what does that mean? Again, we think we got to bring it back to clients and their situation. Most of the clients that we work with, they do this. They worry about their money and have folks like us looked after it, not because they're really want to beat the S&P on a daily basis, even though it always sucks to be left behind. Any human always hates to miss out, and especially if it's being shoved in your face especially when you're negative and the things go higher. But our job is to make sure that clients can be financially secure for the entirety of their lifetimes. And sometimes that is best accomplished by taking a step back and saying, you know what, I don't have to squeeze every bit of return here, because if history's any guide, there's the good chance that we do see some significant downside. And you don't have to be all in or all out. Biggest part of our job is scaling that exposure, but also using hedging tools, for example, to mitigate the consequences of being wrong or being on the wrong side of risk, if you will. Right now, we're about 45% in equities. A third of that we have in international equities, both developed and emerging markets, which categorically are much better valuations. And it's not just valuations, because valuations are poor timing indicators. The rich U.S. stock market has gone up over the last several years despite extreme valuations, yet foreign markets until this year, more or less, lagged quite considerably. We use things like relative strength to help us guide, and that's why we're in the as heavy as we are in the international stocks right now, because they are much better valuations, but they are also showing very powerful momentum and relative strength compared to U.S. stocks, and that's why a full third of our equity exposure is in international stocks. We also have about 10% in gold mining stock exposure. We kind of think of that as a different level of different kind of stock exposure, but we're still underweight stocks compared to what many people think of the traditional 60-40 stock bond portfolio. And we think there's good reason to be, but where you have that exposure in stock, there are areas that are certainly we think more bang for the buck. I just saw some data that we've been in, for example, the industrial and financial sector as two overweight sectors for a while now, and certainly this year. And those are the only two sectors, I believe. Maybe there was one other. Yeah, aerospace and defense as well, which you could argue is part of industrial. Those are the only sectors that both outperformed the S&P on the down phase of this year to date, from January 1st to the market low of April 7th, as well as the bounce phase from April 7th to yesterday. So relative strength works in both ways. These are things that trend and tend to protect better on the downside, but also outperform on the upside. That's the holy grail, if you can be in those areas in the market that have less downside participation, but also greater upside participation. It's not a perfect science, but we use tools to try and systematically lean in that way to get more bang for whatever equity exposure buck we have. But we've increased our equity exposure just in recent weeks, in large part because of some of these price-related and market-related indicators, despite the negative sentiment. And we're not downplaying that sentiment is warranted. It just sometimes the market's going to do what it's going to do, despite how people feel. And look, we have a tweeter in chief that it's a different environment, right? We've never had presidents tweeting like this on such important things like, and I'm not taking a political stand here, it's just to say you being human, not to have some heightened level of sentiment. So perhaps some of these surveys are a little bit more inflammatory than they really are in terms of the market consequence. That's my quick takeaway on that.
Okay. Two last questions here as we wrap up. One is, so you mentioned that you did recently increase your equity exposure, and I was just checking my notes from the last time we talked, and you guys thought more likely than not in the short term that new highs might be likely. Do you still have this short-term bullish bias to the market right now?
Yes, and I'll just pull up a quick chart of the S&P just to give it some context. This is daily chart of the S&P. This is the sell-off into the low on April 7th. Right here is the sell-off after so-called Liberation Day. We had put options hedging a good bit of our equity exposure through this decline. We had a couple different rounds of put options that we booked profits on, so we took a good bit of the sting out of this down, and then we took those put options off around here somewhere. Basically because we saw our battery of indicators suggesting there was going to be follow through to the upside. And we've done that. And we have broken through some really important moving averages, which up until that point were going to be, in our opinion, very significant caps on the upside. But we had this, the 50-day green line here move over the 200-day orange line, and now the 50 days about to, basically has moved above the 100-day moving average. This is so far, a pretty bullish chart pattern. We saw the market, try to dip and close this gap, and it quickly rallied from there. Sentiment-wise, we're probably seeing a little bit of a collective sigh of relief, on perhaps, I think Trump, for example, tweeted yesterday or this morning, that, hey, it's harder to make a deal with President Xi than I thought it would be, is my paraphrasing. And I think the market's taking that to be, well, maybe the hard line saber rattling has run its course, and this sort of Damocles of these punitive tariffs is all but gone. We'll see how this plays out, but we're also seeing the bond market. But the simple answer is yes, we do think that certainly we can pull back to these levels of support. There's always the possibility of a pullback, but we wouldn't be concerned probably of a further follow through unless we took out kind of these important moving average combined with some of our other sentiment and momentum indicators also flashing into kind of a more defensive mode. We don't see that right now, and our simple belief is that we're likely to see a run towards these highs, which is not much further from here, more likely than we see testing of these new lows, by quite a degree. We'll change our opinion on that as our indicators suggest we do, but for now, that's our view. Might as well just talk quickly about the bond market. This is TLT, measure of long-term bonds. We're getting a nice bounce here today, perhaps on this, conciliatory, or what the market I think is reading in its own way, a conciliatory tweet by President Trump, but also, you mentioned some of the, turning of allies in the form of like Elon Musk kind of starting to talk about the tragedy of the one big beautiful bill and the realities of what that would likely do absent, real spending cuts to our fiscal situation. So maybe, and I'm no expert here, we'll have to see how this plays out. Maybe there's a perceived likelihood that the spending bill isn't quite as fiscally irresponsible as or the budget bill as maybe the market originally thought. So
or it could
seen it
be
play out in the market.
Sorry, just to throw another conjecture in there, or it could be in response to the ADP jobs data today, which is, hey, the jobs market is getting weaker than folks thought, and therefore the Fed may step in and cut sooner than anticipated.
Yeah, and there's that's always, there's obviously this very public wrangling going on between President Trump and Fed Chair Powell about you're too late to cut.
Right. And sorry to interrupt, but just on this, yesterday there was a leak basically saying that there's some real dispute at the FOMC at the Fed about whether or not they should be cutting more aggressively. So
yeah, well, that's right, and our take is the negative action we've seen lately in the longer term bond market, notwithstanding today's kind of rebound and seemingly reprieve, has been about things, fiscal things and term premium type risk adjustments, more so than, the Fed really only controls the short end of the curve. And, Jamie Dimon was out a couple days ago, maybe a week ago, basically very publicly talking about his belief that unless we get our fiscal house in order, we will have a major crack in the bond market. And he said, we're going to be fine because we're prepared for it as JP Morgan. But I'm worried about, and of course, his role is not just to be the CEO of JP Morgan, but he's reached that status or stature where he's a policy mouthpiece, right? So,
Right. But also just to folks that saw those headlines and got real worried, he wasn't necessarily saying, I see it happening tomorrow or in the next quarter.
no.
He's basically said, look, yeah, confidence is high it's going to happen if we continue this trajectory, but it could be years out.
Yep. Yeah. In fact, he said it could be 6 months or 6 years. So
Yeah.
that speaks to the timing precision. But my point being is that the Fed rate cuts usually aren't directly, effective on the long end. Those are some other factors that are more like the spending and worries about that. We've continued to see precious metals actually be very strong. Even silver has gotten some life here, which has been a laggard. This is a chart of GDX, the gold miners. This is basically rocketed off the beginning of the year. Here we've had, obviously some pullbacks, but peaked here, and then we had this consolidation phase, and this is, what we call in chart patterns a bullish, a flag breakout with this huge move a couple of days ago on very large volume. We're seeing a major breakout here. Gold has been very constructive. Now, can this pull back? Absolutely. We're getting a little stretch, but the short to intermediate term picture is still very bullish here. We've started to see silver, chime in here, threaten to take out 35, which has been a major like ceiling for silver. But still, so far, we're seeing silver lag in our relative strength indicators compared to gold. But if we see 35 take out, and I raise this because precious metals have been a very important, I think, alternative asset, certainly related to some of the very things that have been plaguing or causing bonds to be weak this year. Central bank, buying of precious metals at the expense of somewhat of dollars and treasuries, and people's worried about the consequences of a fiscal runaway situation here and what that might mean for the dollar. The dollar's been weak. That tends to support things like precious metals pretty strongly.
Right. And look, we'll let Mike geek out next week on all his charts that he likes to do
Yeah, absolutely.
on these sessions. But I want to pull up one chart here from Tavi Costa from Crescent Capital. I just brought this up earlier today in my live stream with Andy Scheckman, but it shows the cup and handle breakout that gold has had. And that silver is tracing a very similar pattern, but hasn't made the breakout yet, but looks very close, like you were saying, John. So are you able to see this chart here?
Yes. Yep. Absolutely.
Yeah. So gold is there in yellow, obviously, and you can see how it's zoomed up to new all-time highs after it broke out of the cup and handle. And you can see silver kind of is just completing the handle right now. And if past is prologue, the silver should start catching up to gold. The gold to silver ratio should start coming down as a result. But we could very quickly see silver at something like $50 an ounce, maybe even higher.
Yep, absolutely. So, Adam, I guess one final point I'd like to make on the sentiment, what we have found is that people, we're human and humans in general, and I know you've had some investor psychology folks on in past interviews, but we tend to be more worried about things that we're uncertain about or haven't asked the questions to really gain a level of comfort. And where I bring this in is in the context of a financial plan for clients, whether it's a qualitative walkthrough or literally a prepared financial plan, which we've got some great software that we can run scenarios for clients that will show under a range of different scenarios how likely it is that their assets will be able to last their lifetimes. Now, I want to make a very big disclaimer up front. There's some great software out there. Any firm can use this software, but we think like with any model, garbage in, garbage out. So categorically, we think the danger of some of these tools right now is people are going to stuff in default return assumptions that are way rosier than they should be, for example, for U.S. stocks at record valuations. So we think it's really important to have the perspective and soberness in terms of the big picture and the data in using these tools. Even like the so-called, all these tools will run like scenarios or simulations that can simulate 1,000 different scenarios of returns, right? And that's a helpful way to frame the uncertainty. The problem with this is that these random simulation, I studied this stuff in college, so I'm kind of a geek about it. They don't acknowledge what's called conditional probability. The probability of a negative sequence of returns isn't always just a random event. It's more probable to happen when valuations are high than when they're low, right? That's just history attests this pretty soundly in terms of a long-term return pattern. So it's important to use these tools in a responsible way with realistic assumptions. But my point being is we oftentimes can go through an exercise like this with clients, and that exercise alone, even if the answer is not completely rosy, can really both comfort them because it's not as bad as they maybe thought it was, or on the other hand, they're better off than they thought they were, and they don't have to take the risk that the industry constantly wants to make them feel like they need to take. The whole mantra, time in the market, invest your money, you got a long time. There are times to be cautious. Despite all the short-term bullish indicators we see, we still think a very pronounced degree of caution is warranted. Someone that's 90% in stocks right now, I don't think for anybody of any age that is the right place to be, given the confluence of factors that we see.
Yeah, the interview that I just did earlier this week with Ted Oakley brought up a chart that showed that older investors have the highest exposure to equities that they've ever had in the data series. And so we spent a lot of time talking about, if you're 50 or older and you're at that level of equities, you really are rolling the dice in a very dangerous way. So I appreciate you bringing it back to the plan, John. We're actually really terrible at judging risk. Evolutionarily, we're wired for a very specific type of risk. We're very good at making the fight or flight decision, right? There's a snarling tiger about to pounce. What are we going to do? We're very good at that. We're very bad at estimating other different types of risks, especially amorphous, intangible ones that aren't happening immediately and have a lot of uncertainty around them. We will oftentimes place much greater probability on events than is really truly the case. And that's where we really get ourselves in trouble, as you and I have talked many, many times. If you're making a decision that's emotionally charged, it's usually the wrong one. You're probably making the wrong decision at the wrong time. So obviously one of the great anchoring benefits that a financial advisor brings is being that voice of reason that sort of forces you to have to articulate past the emotion, and then can give a more reality-based assessment of what probabilities are, right? So that's all great. To your point about the financial plan, a huge fan of them, as any long-term viewer of this channel knows. Totally ascribe to the old saying that to fail to plan is to plan to fail, right? So if you're watching this and you have not done a financial plan or done one recently, you literally are setting yourselves up for subpar performance. And as Lance Roberts likes to say a lot, if it's been over 6 months or certainly a year since your last financial plan, that plan isn't really worth much anymore. Your life has changed, the markets have changed, et cetera. And so you want to be doing this with some regular cadence and checking in with your plan, making sure your goals are still your goals, looking at the market and really trying to ask yourself, what is the best path for me with the least amount of risk to still hit my goals by the time I want to hit them by. So anyways, very much recommend that, again, if people haven't engaged with a plan at all or recently, they do so soon. All right, John, well, look, we got to start wrapping it up here. Folks, if you've enjoyed the conversation with Joanne, please let us know by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. John, I like to think that I try to bring on experts on the channel who I think kind of have a piece of the puzzle. None of us has the whole picture. And I think the whole sentiment angle is a very important one. I've had guys like Peter Atwater on that talk about why at a high level sentiment confidence is so important, but to get the kind of boots on the ground data from Joanne, I think is really super helpful. So I'm glad that she'll be coming back on again in another quarter to give us an update. So anyways, folks, whether or not you think maybe it's time to get a new or an updated financial plan, or whether you just want some help in trying to figure out how to navigate these crazy markets, especially as valuations are beginning to creep back up to these nosebleed levels that we had earlier in the year. Highly recommend that most of the folks watching this program get help from a good professional financial advisor. Importantly, one that takes into account all the macro issues that we talked about here today and on this channel in general. If you've got a good one who's doing that for you, great, stick with them. But if you don't, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd even like to talk to John and Mike and the team there at New Harbor Financial. So to set up one of those free consultations, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. You will get bespoke, customized advice to your own personal situation, and there's no commitment to work with these firms. It's just a service they offer. John, thanks you so much, my friend, for coming back on. Great discussion this week. I'll let you have the parting words here.
Thank you, Adam. Always a pleasure to be with you, and thank the viewers for their attention. Hopefully, they get something of value. Mostly that we should all be pretty humble about this. This is a very tricky place to navigate, and we here do really enjoy the we do get a lot of outreach from your viewers, and some of them become clients, many don't. But regardless, we enjoy the conversations, and we hope to add even some small bit of value in those conversations. So thank you for the opportunity.
Well, great, John. You definitely do. And I think the whole purpose of this channel is to help people become better informed so they can make better investing decisions. If the information and content alone helps them do that, great. But where possible, we like to connect people with real world resources like your firms to help them take action based on this stuff. And from the feedback I get from the many people that go and talk to you and have these free discussions, whether they end up having more with you or just taking that information and doing it on their own, I know you guys are doing a lot of good in the world with this audience and helping people make smarter decisions. So thank you for that. All right, well, great week, my friend. Look forward to seeing you and Mike again next week. And whatever happens between now and then, I know you'll make sense of it for us. Thanks so much, John, and everybody else. Thanks so much for watching.
Thank you, Adam. Have a great day. We'll see you soon.